What is cement? For an everyday person, it's that blackish powder which helps them build their homes, offices, bridges and dams. For a scientist, it's a chemical combination of calcium, silicon, aluminium, iron, etc. And for an investor like you and me, cement is an opportunity to make money. And so in this video, I shall try to cement our understanding of the cement industry from a valuation perspective. This video is the second in our sector analysis series. And by the time we are done with it, you should be able to clearly identify the areas that drive the cement industry in India, the metrics one needs to look out for. You should be able to compare India's top 5 cement companies, and you should be sufficiently equipped to catch an undervalued cement player. And while this video is around cement, I'll request you to all examine it across a spectrum of commodity businesses like sugar, metals, petroleum products, etc. Some parts of the cement framework also being applied to those industries. With that being said, let's begin. The Indian cement industry is huge, and after China, we are the world's second largest producer and consumer of cement. Now, understandably, the demand for cement is directly linked to the economy, with infrastructure projects, roadways, industries, and housing being the major catalysts. In fact, the demand for cement has a high correlation with India's GDP growth, which generally falls within the range of 1 to 1.2 times. So if our GDP grows by some 8.8% over the next decade, which is what a recent Morgan Stanley report predicts, then cement consumption at an average of 1.1 comes to precisely 10% per annum. On the supply side, India has an installed capacity of 540 million tons and operates at a utilization rate of 63%. Now, of this 540 million tons, the top 5 companies, that is Ultratech, Shree Cement, Ambuja, ACC and Dalmia Bharat, have a 50% market share, and this number is expected to rise over the next 3 to 5 years. The cement industry continues to see consolidation mainly through acquisitions, with the latest being the Adani Group taking up a majority stake in ACC and Ambuja Cement. Okay, so this is just an overview, and you'll find a lot of this macro stuff in YouTube videos and also in articles, some of which I have attached in the video's description. But now let's focus on 3 areas which basically defines what being a part of the cement industry is all about. Firstly, cement is a pure commodity product, which means A, it is undifferentiated, and B, because there is no customer stickiness, everything comes down to the price of a bag of cement. Now, I know you'll be thinking of that ad where this guy says,
आप ही ने तो कहा था कि घर जिंदगी में सिर्फ एक ही बार बनता है.
And therefore you should buy Ultratech cement. But the truth is, the cement of a particular grade that is manufactured by one company is hardly different from the other, which means consumers prefer the lower priced bag of cement, and that leads to massive price competition between the cement manufacturers. The second point of note is the cyclical nature of the cement industry. Now, cyclicity happens in 2 ways. The first is at the consumer's end, and sectors like housing and infrastructure have the periods of strong and poor demand. And the second form of cyclicity is the commissioning of new projects. So when demand is strong, most companies would announce expansion projects, and by the time this capacity is ready, there is already a situation of oversupply. It's a cycle that gets repeated every 4 to 5 years, which is why an investor in cement stocks would see periods of highs and lows within them. And the third point, and perhaps the most important factor when evaluating cement companies, is its cost competitiveness. On the face of it, being the lowest cost producer makes absolute sense in any commodity business, which is why every cement manufacturer works continuously to reduce their costs and to keep it at a minimum. Now, one way of doing it is what we read in business schools: run at a high operating efficiency, total quality management, outsource non-core areas of operations, etc. While some of these may work, and I'm sure they work, but in my assessment, there are 3 major costs that an investor should look out for. The first one is power and fuel, and cement companies consume a lot of energy because the manufacturing process requires a lot of heat to be generated. Now, cement players mainly rely on coal for their energy needs, which is why the price of cement moves directly in correlation to the price of coal. So if the price of coal increases, a bag of cement starts costing more, and vice versa. In fact, in numbers, a cement manufacturer spends about 20 to 25% of its operating expenses on power and fuel. Now, to ensure regular supply and to reduce some of the costs, companies generally do 2 things which investors should look out for. Firstly, they would engage into long-term supply contracts of 20-30 years, which saves them 15 to 20% in energy costs. And secondly, many companies invest in captive power, which is a lot cheaper than grid power. Case in point is Shree Cement, where 80 to 85% of its power consumption comes from its captive plants. The second major component is the cost of transportation or freight. You see, cement is a heavy commodity, which is why it is difficult and economically impractical to sell it at a place that is far away from the manufacturing plant. And this is the reason why there is almost zero competition from imports, because the shipping cost itself makes the entire setup unviable. So on an average, the cost of freight is about 20 to 25% of a cement company's operating cost. And for things to be profitable, the transportation of cement should be limited to about 200 to 300 kilometers from the plant. This is also the reason why cement companies prefer to have plants all over the country rather than shipping the product from one central location. The third major cost component in cement production is the raw material. Now, limestone is the primary raw material, and a lot like fuel and transportation, this also works up to between 20 to 25% of the operating costs. Understandably, cement plants are generally concentrated in areas where there is plenty of limestone available, but that doesn't mean manufacturers have not been innovating on this front. For example, there is this process called clinkerization, which not only reduces cost, but allows cement companies to move farther away from the limestone quarries. Now, the issue with a material like limestone is that it has to be mined, and mining rights are allotted by the government, which creates a barrier for entry for newer players. But as the saying goes, necessity is the mother of innovation, and today's manufacturers have found the use of alternative products like fly ash and slag, which helps in the making of blended cement that is a lot cheaper than ordinary Portland cement. In fact, India has quickly transitioned into a blended cement market that today accounts for 80 to 85% of the total cement production, and it's a shift that significantly improves the cost competitiveness of cement companies. So to sum this up and to put it in the simplest way possible, if you find a cement company that has the lowest energy cost, the lowest transportation cost, and the lowest cost of raw materials, then keeping everything else aside, you might have found a winner. Now, before I put all this together in a company-wise comparison, let's look at a few more areas you need to know as an investor. Firstly, the economies of scale matters in cement production. And as a company expands its capacity, it's able to spread the fixed costs over many bags of cement, which triggers a reduction in the per unit cost of production. This is also why M&A activity is so common in the cement industry, not only in India, but almost everywhere else. For example, in Japan, the top 3 cement companies control 80% of the market there. And speaking of control, it's very common to see cement companies resorting to cartelization and collectively fixing the price of cement to protect their margins. If you want to know more about that, then read up more about why the Competition Commission of India slapped a penalty of 6,700 crores on 10 Indian cement companies a few years back. The sixth point of consideration is the manufacturing technology. And in an industry where controlling costs is so important, the advantage always goes to companies that imbibe the latest plant technologies. For example, older plants produce cement using something called a wet process, which is energy intensive and therefore cost ineffective. On the other hand, newer plants manufacture cement using a dry process, which is superior in terms of fuel economy and therefore cost efficient. Now, as an investor, the knowledge of which technology the company is using in its plants is really important. For example, the cement division of Century Textiles and Industries had this very issue, and many of its plants were very old, inefficient, and therefore economically unviable. In fact, one of their plants in Chhattisgarh was 44 years old and required huge upgrades for which the management was unwilling to commit any capital. All this almost resulted in the cement division going bankrupt before Ultratech acquired it in 2018. Alright, so this is already a lot of information, but look at it this way. In just 20 minutes, we are able to go through the most important components of an industry or sector in a simplified format where all this information can help us value cement companies better and even profit from it. In fact, if you want to improve retention, I'll request you to definitely watch this video a second time. Okay, now that we have gone through the foundation, let's put this all together and examine these points for India's top 5 listed players in the cement business: Ultratech Cement, Shree Cements, Ambuja, ACC and Dalmia Bharat. As I've said it multiple times now, the first and foremost variable to consider is cost. And more precisely, we are looking at comparing the cost per ton for each of these 5 companies. So as it stands, Shree Cement has the lowest cost per ton, while Ultratech has the highest cost per ton. Of course, it's advisable not to blindly read this data from a list, but to also understand the regional demand-supply dynamics, which I'll cover in a couple of minutes. But yes, Shree Cement has a low cost base, and that's because of its close proximity to end user markets, the company's use of split grinding units, and its in-house power generation capacity, which makes the company the most efficient player in the industry. In fact, the slide here shows the cost breakdown of each player, and this is an important chart for investors as they can now compare the operating cost on a component level and compare it with the initiatives that the company is taking to bring it down. The second important variable is the profitability, and the EBITDA per ton is the primary metric here. EBITDA is what remains after the operating costs have been subtracted from the revenue or realization, as the cement industry calls it. As you might have expected by now, the realizations and costs never grow at the same rate. You are likely to see periods where the price of cement grows faster than the cost, which indicates a period of high profitability, and other times the increase in cost is a lot higher than the revenue, like what we saw in the first half of 2022. For investors, the EBITDA per metric ton is an important statistic to watch out for, especially now with many cement companies reporting the lowest profitability per metric ton over many years. On a comparison basis, Ultratech and Shree Cement top the charts with an EBITDA of over 1,200 rupees per ton. But remember, this is a fluid number and things can change very fast with unexpected changes in the cost of raw material, power and transportation. But all said and done, in my view, the EBITDA per ton is the best metric to measure a cement company's profitability, as it is the result of a lot of small things done right. Things like better pricing power, higher realization, better raw material costs, improved overhead absorption, strategic placement of plants, etc. The third factor when comparing cement companies is the geography, and India is divided into 5 cement markets: North, South, East, West and Central. And each region has its own demand and supply dynamics, which has a major impact on the capacity utilization. For instance, the South region has the largest installed capacity, and that's primarily because of an abundance of limestone deposits in that part of the country. Understandably, this has led to a low capacity utilization rate in South India based plants, while plants and companies operating in the northern part of the country continue to see higher demand of cement. Now, the general rule is higher the utilization rate, more is the pricing power. And it's really this pricing power that supports any kind of price hike that the cement company would want to make. To put a number to it, once the utilization level starts touching 80%, the cement manufacturers start getting a lot of pricing power, and invariably the price of cement in that region starts increasing. Now, this demand-supply dynamics also has a strong bearing on a cement company's weighted realization price and how investors perceive risk, which is also why we see many large players acquiring smaller companies, especially in regions where they are capacity deficient. The fourth, final and most critical part when an investor evaluates cement companies is, of course, the valuation part. Now, a number that is routinely used in not just valuing companies but in also acquiring them is the EV per ton, or enterprise value per ton. It's a classical way of valuing any commodity business where one weighs the per unit price of that commodity, which in this case is a ton of cement. Now, for our 5 large companies, the EV per ton ranges from $103 per ton, which is where Dalmia Bharat is at, to $209 per ton, which is what Ultratech commands. So Ultratech's EV per ton is double of Dalmia Bharat, which in my opinion is quite a wide berth. But where this analysis becomes even more interesting is when we look at the EV per ton across large, mid and small size cement companies. Notice here that an average mid-sized cement player is trading at a 40% discount to a large size cement company, and in case of smaller cement companies, this discount is even bigger at 70%, which can lead to some interesting valuation plays. Alright, so let's put everything together from an investor's perspective in 5 simple points. Number 1, the cement industry is characterized by intense price competition, which means you should prefer companies that have a low cost per ton. Point 2, always be on the lookout for companies that are trying to reduce costs by either setting up their captive power plants or employing a dry process technology, clinkerization, moving into alternate products, etc. The third point is the entire regional demand-supply dynamics, which has a bearing on realization price and therefore the profitability. And speaking of profitability, there's this fourth point where investors should closely look at the cement company's EBITDA per ton. And finally, we look at the enterprise value or EV per ton as a viable way of gauging what the market is ready to pay for the company. In fact, this concept of EV per ton can be extended to mid and small size cement companies, which are potential acquisition targets for the larger companies. To conclude, and in my opinion, the cement business in India is a beautiful business with companies producing an essential product, with most of them carrying very little debt, high levels of profitability, and excellent operating and free cash flows. And while it is a cyclical business, with a little understanding of the sector as I've tried to impart in this video, and with a few hours of research on your own, you would be able to find undervalued companies to invest in and make some profit from it. I sincerely hope you found this sector analysis useful and will appreciate if you can like and comment on this video. Thank you for your time, do subscribe to my channel, and I'll see you next week. Until then.